account to work. We see it frequently in young people having the assumption that the best place for your hard-earned money is a savings account. While savings accounts offer security and easy access to funds, there are several disadvantages to leaving money in a savings account. The biggest disadvantage being lost investment opportunities. By keeping money in a savings account, you miss out on potential gains that could be achieved by investing in other assets. Investment stocks, bonds, and real estate have historically provided higher returns over the long term. By not exploring these investment opportunities, you may miss the chance to grow your wealth and take advantage of the time value of money. Frequently, young investors get into a mindset that having a good amount in savings is the best place to park assets and leave for future use. However, there are many better uses that will allow you to not only score higher returns for some investments, but give you a physical asset that you can put to work over time. While there's a variety of channels and avenues to invest this money, such as the stock market, mutual funds, or precious metals such as gold or silver, the avenue that I recommend is real estate. This is for a couple of reasons. Firstly, real estate, unlike some of the other investments named earlier, gives you physical property that is yours to appreciate, enjoy, and most importantly, make money off of. Let's dive into 4 wealth generators of real estate investments. The greatest generator of wealth is appreciation. There are 2 ways in which appreciation can take place, which are natural or forced. In terms of investment properties, forced appreciation occurs when an investor, such as yourself, chooses to rehab a property to increase overall value. A popular method of rehabbing homes for investors is known as the BRRRR method. This acronym stands for buy, rehab, rent, refinance, and repeat. I'll give you a quick overview of how this investment strategy helps investors diversify their portfolios while maximizing their returns. Basically, the strategy involves buying fixer-upper properties, repairing them, renting them out to reliable tenants, pulling money out of the property through a refinance, and then repeating this process to grow your portfolio. BRRRR really makes it possible for investors to acquire multiple properties without running out of capital to invest. The second wealth generator is cash flow. The majority of investors do thorough market research to find properties that best suit their goals and generate a stable return on their investment. Resources such as AirDNA or Zillow can be used to understand potential markets to ultimately find a property in a good market with reliable cash flow. Having this solid cash flow is a huge benefit to real estate investing compared to other investment vehicles for a couple of reasons. First is the reliability of this income stream. Even the most reliable dividend stocks can always decide to reduce or eliminate their dividends on a whim. This, of course, is not a problem with real estate investments that you control yourself. Another aspect of the real estate property cash flow is that after deducting your mortgage, utilities, and maintenance expenses, you can have cash on hand that can be used for additional investment purposes. Those who invest in real estate are also capable of generating wealth through tax-saving benefits. The government tends to encourage real estate investors through favorable tax treatments. A 1031 exchange is a real estate investing tool that allows investors to swap out an investment property for another and defer capital gains or losses that you would otherwise have to pay at the time of the sale. It's important to note that although you can continuously defer these payments with each additional property, a capital gains bill will be due at some point, and to not forget about that. For those fixing and flipping homes or using the BRRRR method, you can take advantage of cost segregation. Cost segregation is a way for real estate investors to more quickly deduct the depreciation of a property. This depreciation can be written off on your income taxes over a period and varies depending on the type of investment property. Cost segregation, though, allows you to speed up this depreciation schedule, increasing the amount you can deduct each year. By using this strategy, you will reduce the amount of money you owe in your income taxes each year. This also reduces the expenses of owning investment real estate. For example, if you were planning on rehabbing a home, you should first order a feasibility analysis. A team will usually inspect your property top to bottom, gather necessary documents such as blueprints, property records, and inspection reports to determine whether the property is a good candidate for cost segregation. This final report can determine the size of your tax deduction based on your rehab. The final wealth generator is the loan paydown. Simply put, after you've secured a loan on your rental property and you have tenants in place, you can use the cash flow generated by the property to pay your mortgage down. Now, it can be tempting to use this cash for other expenses, maybe paying for groceries or clothes, but it is smartest to put this money towards pay down of the loan. This is due to the principle of compounding interest. Essentially, reinvesting your generated income back into your business will allow it to grow exponentially over time, giving you more opportunities to build your real estate portfolio. Now that we've identified and gone over the 4 main wealth generators of investing in real estate, do your savings account a favor and put your money to work. Well, that's a wrap on this video. Thanks for watching. Be sure to like and subscribe to Easy Street Capital on YouTube for more industry insights.